Good morning and happy Friday, all you wonderful melon heads out there. I hope you guys are well. Today is May 19th, 2023, and Uncle Sam and Aunt Janet over at the U.S. Treasury are down to just $68.3 billion. That's it. I mean, in Washington, D.C., you can't even change a toilet seat for that. $68.3 billion left in the Treasury General Account. 3 or 4 days ago, folks, that was over $200 billion. So understand, Uncle Sam is burning through their cash at an alarming rate, down to just a couple of days. Now, they're saying June 1st is the X date. June 1st is the day the government would actually default. I've seen some analysis out there, some very detailed analysis, mind you, that says, no, we can make it until a few days after June. I'm sitting here just watching the trend line of how fast that balance is dropping, and I'm saying we're not even going to make it until June 1st. The ground is getting closer. It's getting closer very fast. And, I don't understand these June estimates. What happens between now and then? Where's all this money going to come from? I just don't see it. So 68.3 billion, folks, that is it. A couple of days. We've been burning through roughly 10 to 20 billion dollars a day. They need to announce a deal like now. Announce the deal because it's going to take a couple of days of procedure and votes and finalizing just to get it done. And the likelihood of an accident, I've mentioned this a couple of times on my channel, the chance of an accident, the likelihood that somebody introduces some amendment at the last minute that costs that one crucial vote in the Senate, that one vote that goes away because somebody made some stupid speech or introduced some amendment or some unrelated thing happened, some political accident. We're getting closer and closer to that the more they play this game. Elsewhere in markets this morning, we had Footlocker earnings were just absolutely abysmal. Now, when I first saw that story, I kind of glossed over it. Okay, Footlocker, nobody cares. It's a mall stock, right? The mall is dying. Nothing new there. And then I was talking with my moderator, Mitch, this morning, and he's like, no, it was really bad. And Nike and Under Armour are going down with that ship. And so I looked close and, oh my God, it was so bad what happened at Footlocker. Some of these numbers at Footlocker, and keep in mind, Footlocker gets something like 60% of its sales from Nike. So this is very much a Nike stock, right? Footlocker earnings per share down 56.2% year over year. That's just a gully, folks. Don't worry. Revenue down 11.4%. So as their revenue shrinks, all their profit is just being wiped out. 56.2% year over year decline in earnings per share. That is a bludgeoning, folks. Same store sales. Again, I've talked about this a couple of times this week. It's a recurring theme we're seeing in retail stocks right now. Same store sales down 9.1% year over year. That's a death sentence in retail. The profit margins at a location like that are just not good enough. Foot Locker's not going to make it, folks. At this rate, at the rate the American consumer is being squeezed by inflation, and we saw it in Target earnings, they're cutting back spending in sectors like apparel, like home goods, like luxury items. A company like Foot Locker is not going to make it in this environment if something doesn't change quickly. And with that, we are going to shrink my big melon of a head. And sure, stocks go up. Why not? Stocks only ever go up. This market has nothing to do with companies and how much money they earn and what shares of those companies are. No, this market is all about hope and hype. The hope of a less aggressive Fed, the hope of Jerome Powell going burr again, the hope of a debt ceiling deal getting reached, and the hype of artificial intelligence, which doesn't make any money yet, even though any company that has mentioned artificial intelligence on their conference calls has gained something like $2.5 trillion in combined market cap so far this year. Hope and hype, that is what is driving this market. And the S&P this morning is up another 9 points or 0.22% at 4,207. Number go up. Same thing over at the Dow, up about 18 points or 0.06% at 33,554. And the NASDAQ, the mother of all bubbles, 12,715, up another 26 points this morning or 0.2%. Big tech just only ever goes up. The DXY is taking a little bit of a breather this morning, currently at 103.32, down 27 basis points. It had quite a rip yesterday. The DXY, the strength of the dollar, has broken out of the holding pattern that it was in for the better part of a month. I talked about this in my video yesterday about Janet Yellen and what comes after the debt ceiling gets raised. Janet Yellen is going to borrow $1 trillion just as soon as the debt limit gets raised. That's $1 trillion worth of liquidity that is going to be sucked out of the bond market, driving interest rates higher, driving the DXY higher. And I think the market is starting to sniff that out, although this morning it is pulling back from recent highs. And that's the best case scenario. That's if the debt ceiling gets raised on time and we don't default. The other scenario is interest rates approach near infinity if we default, because nobody is willing to lend dollars under any circumstances when the U.S. government defaults. Looking over at the bond market right now, we've got yields are a little bit higher this morning. The 10-year is yielding 3.71. We've actually had a kind of quiet creep up in the 10-year over these last few days. We were down around 3.4, 3.5 not too long ago. Up another 6 basis points this morning to 3.71. Got the 2-year yielding 4.31%. That's up 4 basis points. And the 1-month T-bill is now yielding 5.49%, up 8 basis points this morning. Looking over at commodities, gold and silver are finally getting a break from the bludgeoning they've gotten this week. Gold is at $19.61, up about $1. Silver is up 10 cents at $23.74. Both precious metals have taken it on the chin this week from the higher dollar and the prospects for higher interest rates. We've got crude oil is at $72.50, up 64 cents, and natural gas continuing its run, up $2 or at $2.64 now, up another nickel this morning. Natural gas has done really well lately. But here is the story today. This is the daily Treasury statement. This gets published every day. Sometimes the date is a little bit delayed, but this is the statement for May 17th. As of 2 days ago, Uncle Sam has, here it is, let's zoom in, make it nice and big, $68.3 billion left in the Treasury General Account. That's all they got. They burned down by about $26 billion on the 17th, now down to 68.3. And just a quick update on what's going on with the debt ceiling real quick. I don't want to spend too much time on this, and I don't want to get too political, but this is out there. They're sounding optimistic tones. Here's some of what is holding up the deal. Right now, spending caps is one of the issues. At the heart of the deal is setting a discretionary spending cap, and there are fresh signs that the two sides are moving closer to each other's positions. So there appears to be some movement on that. Republicans want to slash domestic spending over a decade, while Democrats prefer smaller cuts over a couple of years. Look, what's probably going to happen with spending caps is it's going to be accounting gimmicks that really just makes it look like a spending cut. Let's be honest, neither party is really serious about ever cutting spending. So they're probably going to move some numbers around on a spreadsheet that's going to make it look like a spending cap, but it's going to have very little substance. Now, another thing that should not even be discussed, but for whatever reason this is on the table, is COVID clawbacks, which is basically not spending money that was included in previous COVID stimulus, because at risk of getting my channel banned forever, or so, like, let's be honest, it's over. Even the World Health Organization declared an end to the emergency. So why are we still spending COVID stimulus? It's stupid. Anyways, that's on the table. There is somewhere between $56 and $65 billion of unspent COVID money that's still out there. And they're trying to figure out, is it 56? Is it 64.6? How much of that are they actually going to claw back, i.e. not spend? This is a no-brainer. Why are we even talking about this? Moving on. Another thing that is stupid, and we shouldn't even be talking about it, it should just be a thing, is work requirements for able-bodied people to receive government assistance. Keep in mind, we're not talking about the elderly, the sick, or the mentally disabled. We're talking about able-bodied adults whose existence is being subsidized by productive people. They should be at least forced to try to work. No? I mean, I just throw them out there. You guys do what you want with them. Work requirements, a bill that House Republicans passed in April, which wasn't taken up by the Senate given Democratic opposition, featured new work mandates for able-bodied Americans on Medicaid and stricter ones for those using food stamp programs or welfare. Now, look, I don't want to say like, oh, I want to take money away from the poor. That's not what this is. We're talking about able-bodied people, okay? People who, there is no reason why these people can't work. Now, I understand if they can't find work, that's fine, but you at least have to look and prove that you're trying to look. That's not asking a lot. And, of course, anytime you talk about something like work requirements, you get just the worst political posturing. Oh, they want to take money away from poor Timmy and they want to starve people. No, we're talking about able-bodied people here. And another one, a no-brainer, permitting reforms. And before we get into permitting reforms, let me just talk about this. All right, this is a story that was in the Wall Street Journal just yesterday. All right, the U.S. fast-tracked this solar power project 17 years ago. 17 years ago. We fast-tracked this solar project. I think it was in Arizona They just got the permits approved yesterday. Fast-tracked. 17 years ago, permits approved yesterday. All right. How do you get anything done, anything built? How do we modernize a power grid? How do we electrify transportation? How do we make EVs a thing all over the world? If it takes 17 years to get a power plant built. When plans for the SunZia project, a massive power line and wind farm in the western U.S., were first laid in 2006, Taylor Swift had just released her debut album and George W. Bush was president. The project finally received a crucial permit this week. The permit, guys, they didn't build it. It's not done. It's not running. They signed the permit. 17 years of paperwork. How much money did they spend on this? All right, this is for a wind farm and power transmission lines. That's something like everybody's like, yeah, oh, we need to build solar and wind. And yeah, we did it. Imagine trying to build a nuclear plant. Imagine trying to build an oil refinery. Forget it. Analysis paralysis is what this is. We just cannot get out of our own way. We just can't build things anymore. This crap has got to stop. And this is one of the things that's on the table with the debt ceiling deal. It's one reason why we should have a debt ceiling is because periodically it forces us to review these no-brainer, idiotic things that should go without saying, but for whatever reason, these highly paid, highly powerful people in Congress never fix these problems. Well, the debt ceiling is a good opportunity to do that. So if anything good comes out of this political circus that is the debt ceiling deal, maybe it can be permitting reforms so we can actually get a pipeline built. We can actually build a power line. We can actually build out an EV grid. We can actually build wind and solar plants if you're into that kind of thing. And maybe we actually build a nuclear plant which can actually power a modern industrialized society. Period. Hard stop. End of rant. Moving on. I hate this topic. Footlocker. Here we go. Footlocker stock plummets after slashing profit forecast. Nike and Under Armour slump as well. Our sales have since softened meaningfully given the tough macroeconomic backdrop, said CEO Mary Dillon. Now, how much have they softened? Quite a bit. Look at some of these numbers are just so bad, folks. Footlocker shares plunged lower Friday after the sports goods retailer slashed its full-year profit forecast following weaker than expected first quarter earnings and meaningfully softer overall sales. Footlocker said, look at these numbers. Adjusted earnings for the 3 months ended in October came in at 70 cents per share. 70 cents a share. 56.2% lower than the same period a year ago. All right, it's slightly below expectations. 56.2% lower. Revenues fell 11.4% to $1.93 billion, and same-store sales fell by 9.1%. And I keep pounding the table on that number. Same-store sales, folks. That is so important in a retailer. You can skip all the numbers. If there's one number you look at in any retail or restaurant chain, it's same-store sales. And that tells the story. Footlocker is done. This company they won't be here much longer. I don't think they survive this. The group, which relies on Nike for about 60% of its annual sales, I had no idea it was that high, now sees fiscal 23 profits between $2 and $2.25 a share, down from its prior forecast of $3.35 to $3.68. Well, gee, that's only about what, a 40% reduction in their earnings per share estimates for the year, with full year sales falling between 6.5% and 8% from 2022 levels. And looking at the stock this morning, you'd think this was a regional bank stock. No, this is Footlocker, down almost 25% at this point this morning, and it's taken Nike down with it. Let's look at Nike stock, down 4% this morning. I know a lot of you guys probably will not be shedding any tears for Nike. I won't get into that too much. But Under Armour is not faring much better. Let's see. Under Armour is down just about 3% on the same news. When the people who sell Nike and the people who sell Under Armour, when their earnings are down 56%, yeah, Under Armour and Nike stock, they're going to go down right along with it. And guys, that's about what I got for you. Even though there is just no shortage of economic bad news, take a look at that S&P chart. Number only ever go up because the market is built on hope and the market is built on hype. And that is only the story for the time being. Sooner or later, something gives. Markets, they can stay irrational longer than you can stay solvent, but eventually this market will need to snap back to reality. AI may be a huge thing 10, 20 years from now, but right now AI is just a fad that people talk about on conference calls. It's virtual reality, it's blockchain, it's snap bracelets, pet rocks. That's what AI is. It's very useful. It's a productivity enhancer, but it is not worth trillions of dollars yet. And right now, all you have to do is say AI, and your stock will go up by hundreds of billions of dollars. And, there's hope that the Fed is going to turn on the money printer again, so stock markets just go up on hope and hype. That's all they ever do. So, anyways, guys, I just want to say thank you very much for your time. Thank you for watching and listening to me rant. Thank you very much to my Patreon supporters for everything you guys do for the channel. I really appreciate it. There is a link down below should you feel so inclined. Hi, Mom. Hi, Dad. I love you guys. And I'll see everybody at 3:15 p.m. Eastern Time for my weekly wrap-up live stream this afternoon, my favorite time of the week. Until next time, live small and dream big.